Well, there's some positive news on the housing market. New data is suggesting an end is in sight to the East Coast property downturn. As Christy Coulter explains, there's been a turnaround from the falls of last year.
Banking Royal Commission, a slowing economy and election uncertainty had been weighing on Australian property prices, but we're starting to see some improvements. It looks like the property market is starting to find its feet. A preliminary look at this month's sales indicates prices levelling out after the drastic falls of 2018. CoreLogic data shows the first 26 days of June saw prices track just 0.2% lower on average across Australia's 5 largest capital cities. Sydney values edged just 0.1% lower, while Melbourne posted a subtle rise of 0.1%. It's in stark contrast to December 2018, where values in Sydney and Melbourne fell almost 2%. The ongoing trend toward smaller value falls indicates early signs house prices will soon be on the up. Domain predicts the Sydney market will grow 2% by Christmas, followed by up to 5% growth next year. In Canberra, prices are expected to grow 2% over the next 6 months, followed by another 4 to 6% across 2020. Melbourne is forecast to see a more subdued house price growth, an increase of 1% over the second half of this year and another 1 to 3% next year. The big test, however, will come in spring when more properties hit the market to meet buyer demand. Christy Coulter, Sky News.
Joining me live now for more on this is Cameron Cusher from CoreLogic. Cam, these figures are CoreLogic's figures, so I guess it might be a little bit preemptive of me to ask you, but should we be looking into these too much? Is this really the market bottoming out?
Well, I think if you look at the trend, Stacey, what we've seen is that on a monthly basis, the falls were at their largest either December last year or January of this year, and every month since then, we've seen the rate of decline slow. So, as you said in the intro there, we've seen so far this month, Sydney's down 0.1% and Melbourne's up 0.1%. And if that does hold to the end of the month, that will be the first positive monthly reading for Melbourne since, I think it's November 2017. So, you know, we don't get too excited about 1 month's worth of data, but if you look at the trend, the trend is certainly showing that the rate of decline is slowing and conditions are slowly improving.
And those figures for Sydney and Melbourne seem to be following the national trend where prices are stabilising across the country?
I mean, the national figure is really driven by what's happening in Sydney and Melbourne. If we actually look at some of the other capital cities, there's been a fall equivalent to what we saw last month in Brisbane. Perth is down about 0.9%, so it's actually still falling fairly sharply. And from memory, the Adelaide market was down 0.3%. So really, it's quite interesting because Sydney and Melbourne have been the areas where we've seen very strong growth over the last decade or so, and there's been very little growth elsewhere. And now that the market looks to be recovering, it's actually driven by those two cities, whereas the other major capital cities are continuing to show weakness. Now, they may lag behind Sydney and Melbourne a couple of months, but if you look at Sydney and Melbourne, they've still got very strong economies, still got very low unemployment rates, still got very strong population growth into those cities, and that's clearly driving demand for housing. I guess the big thing that was missing was that level of confidence, and we've seen confidence really improve quite dramatically over the last few months.
And we have a number of reasons for that confidence. Of course, before a federal election, we always have less confidence, or the market does tend to see that just because we don't know what the result is going to be. But now we have a result and we have those proposed changes to the APRA stress test rules. We've had one rate cut, possibly another on the way next month. That all seems to be looking good for the market.
I mean, they're all positive for the housing market. I guess the area of caution I would highlight is that we have got comprehensive credit reporting changes coming in, and that's going to mean that there's more pressure on the banks to write good loans because they're going to have a lot more information about people's debt levels, and not just debt with the bank that you're applying for a mortgage with, but with all other banks as well. And even though we are getting some of those stress tests eased off a little bit, it's still going to be a lot harder to get a mortgage than it was before 2014. So whilst the recovery or the improvement in the market is slow, we think even once the market turns into a growth phase, it's going to be a fairly slow growth phase going forward.
Okay, so what positives, if any, can we take out of the market at the moment? I guess is now a good time for first home buyers to be trying to get in, or investors trying to snap up a bit of a bargain if we are aiming to see the bottom of the market cycle?
Well, I think the growing evidence that the market's at or close to the bottom will start to encourage more investors back into the market. Keep in mind they still have interest rate premiums over and above owner-occupiers. We may see some more first home buyers willing to come into the market now as well. I think if we look at over the last 6 months or so, the market's been falling fairly rapidly. So for most of them, it's probably been better off to stay on the sidelines, save up a bigger deposit. But now that the end of the downturn looks close, I wouldn't be surprised to see a little bit more activity from the first home buyers. And of course, people looking to upgrade. What we have found with the market is that it's been the more expensive properties that have seen the larger falls. So even though your property might be worth less, if you're trying to upgrade into a better property, the value of that home has probably fallen by a greater amount. So your dollar will go a little bit further, even if you are selling at a slight loss.
There's a couple of other factors we haven't looked at. Auction clearance rates seem to have been improving over the past couple of months. That's a good sign for the market generally as well, isn't it?
It is. So the auction market is still a pretty small overall proportion of the market, about a third of the market in Sydney and Melbourne, but it is a real-time indicator. And we do find when auction clearance rates are weak, the housing market's falling, and when it strengthens, we see improved housing market conditions. And really, since the week following the election, we've seen auction clearance rates not bounce back to boom time levels, but certainly bounce back to levels indicating that there's going to be some subtle growth in the market. So, you know, all the signs are pointing to improved housing market conditions. I would just caution that we don't think this is going to be a return to boom time. It's going to be a slow recovery. And remember that the Sydney market's down about 15% from its peak. Melbourne's down about 12% from its peak. So even once that recovery does start, it's got a long way to go to get back up to those previous heights.
Certainly does, and we are expecting those June index results to come out next week as well. So I guess we'll have a bit of a clearer understanding once they are released, those CoreLogic figures. We look forward to them every month. Cameron, thanks so much for your time today.